Hi, my name is Dan Keegan, and I've been in the options trading business for 30 years, including over 20 years right here at the Chicago Board Options Exchange. During this course, I'll share with you some of that knowledge that I gained during those 30 years. When I started working on the exchange floor, I didn't even know what an option was, but with the help of the people who started before me, I was able to learn everything I needed to know in order to trade successfully on this floor. The purpose of this course is to provide that same kind of mentoring and training that I had when I first started trading options. Nowadays, the trading floors are vanishing, and almost all options are traded electronically, either in a trading room or by people just like you on their home computer. When you have finished with this course, you will have the tools that are necessary to make money by trading options. As you watch and listen to the online instructions, remember to take your time and make sure that you understand the lessons. If there is anything that you still don't understand, just ask your mentor when your mentoring session starts. Feel free to watch any chapter or section over and over until it becomes clear. For those of you who already have some background in finance or stock trading, some of this will seem like old hat. For those of you who are new to the business, you'll find some of the concepts a little confusing at first, but if you are like most people, it will get easier as you go along. There's a common misperception that successful traders have a knack or a feel for it. Some sort of magical luck is involved. Nothing could be further from the truth. There is no luck or magic behind it, just hard work and discipline. Before beginning to trade, you must realize that even the best traders have losing trades every day and have losing days and even losing weeks. If any of you are poker players, you understand that no one can win every hand, but that good poker players know how to maximize their winning hands and cut their losses on bad hands. Successful trading is similar. Minimize your losses and maximize your gains. In order to accomplish that in options trading, you must understand the fundamentals of options and options trading. This class will take you through those fundamentals and into advanced trading strategies. Mastery of those fundamentals and strategies is the first step in successful trading. One more thing to remember before we start. Traders never stop learning because markets never stop changing. Successful traders learn something new with every trade. Let us begin by discussing just what stock options are. Maybe you are familiar with the concept of renting with the option to buy. Let's say you purchase an option on a home for $10,000 that enables you to purchase the home for $400,000 1 year from now. The current market value of the home is $380,000. The owner of the home allows you to resell that option at your discretion. This allows you to size up the market over the next year. In essence, you are buying time. Let's say the value of the home rises to $450,000 in the 7th month of the contract. What would the resale value of that option be? Well, I would think that it would be worth at least $50,000. Wouldn't you? Let's say that in the 7th month, the value of the home has declined to $365,000. What would its value be? Obviously, it wouldn't be worth $10,000 anymore. It still has 5 months left, so it would be worth something. Who knows, maybe oil will be discovered in the backyard. Let's use a third example. Let's say the value of the home stayed at $380,000 after 7 months. Since the value of the home stayed at $380,000, shouldn't the value of the option remain the same? The answer is no. While the value of the home has remained constant, there is less time left for something to happen. If you understand our option to buy example, you can understand stock options. Where did stock options come from? The first known options contract occurred in the 17th century Holland during the famous tulip craze. In 1623, a single tulip bulb could fetch 6 times the average annual Dutch income. By 1635, tulip bulb prices had tripled. Wild speculation had driven the prices up so high that a market developed in tulip seeds that had not yet become bulbs. This was, in effect, the first futures contract. Traders then began buying and selling the right to buy developed bulbs, thereby giving the world the first known options contract. When the tulip market crashed, those speculators who had sold options or futures looked like geniuses. Those who had merely purchased options got hurt less than those speculators who had purchased the actual bulbs. Traders had learned that owning tulip options rather than actual tulips would have given them more leverage on the way up and less risk on the way down. Modern options trading began with the trading of warrants. Warrants give the holder the right to purchase securities, usually equity, from the issuer at a specific price within a certain time frame. Warrants are often included in a new debt issue as a sweetener to entice investors. For a long time, warrants were pretty much ignored and were not held in high regard until Edward O. Thorp came along. You blackjack players might be familiar with his book, Beat the Dealer, a winning strategy for the game of 21. He also published Beat the Market, a scientific stock market system. This book dealt with the pricing of stock warrants. Thorp found that the pricing of these warrants were all over the board. He took advantage of this with the first stab at theoretical pricing. His methodology was crude, but the results were revolutionary. Since the number of warrants issued by a company was limited, it was difficult for the public to utilize Thorp's theories on pricing. This led to the concept of publicly traded options on equities. Unlike warrants, options are issued by an exchange, not a company. Since the inception of options trading, mathematicians, economists, and other scholars have created their own pricing models to try and determine what the premium for a given option should be. The most well-known of these is the Black-Scholes model, which was put together by Robert C. Merton in a paper he published in 1973, based on the work already done by Fisher Black and Myron Scholes. Merton also incorporated the work of our old friend Edward O. Thorp and others into his model. This work resulted in a Nobel Prize for Merton and Scholes and helped spur interest in options. There have been countless other pricing models since Black-Scholes, and every options trading firm uses one of these models to figure the relative value of options. All of these models involve very complicated mathematical theory, and I'm not about to try and teach that in this course. Besides, it is not necessary for you to master these pricing models in order for you to trade options. Your clearing or brokerage firm will provide you with their theoretical pricing model, and traders can obtain different models from a variety of different sources. In 1973, the same year that Merton published his Black-Scholes paper, the first listed options exchange was founded in Chicago. The options that were first listed on the Chicago Board Options Exchange were options on stocks. Originally, only call options were listed. What is a call option on stocks? A call option on stocks is an agreement that gives an investor the right, but not the obligation, to buy a specified amount of stock, usually 100 shares, at a specified price within a specific time period. These options derive their value from the value of the underlying stock, hence the term derivative. Incidentally, when you hear about a company giving stock options to a new CEO or other employee, those are always privately issued call options, usually at a price above the current stock price. These options have restrictions in their transferability and act as an incentive for employees to increase the company's stock price. What we are talking about in this course are publicly traded, exchange-listed options on stocks. While call options derive their value from the value of stocks, they are not the same thing as stocks. Call options expire after a certain date. Owners of call options do not have voting rights and do not receive any dividends. So why do people trade them? The answer is simple: leverage. Archimedes said that if he had the proper fulcrum, he could lift the earth. Leverage makes you bigger than you actually are. Okay, if leverage is a major advantage of options, what is the biggest disadvantage of options? The answer is time. Remember I said that a call option gives you the right to buy stock within a specified period of time. Well, once that period of time is expired, so is that option. We will talk more about option expiration in the next chapter, and we will explain leverage in greater detail in Chapter 4.